Hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel, we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest costs compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For that, this person has a Capital One credit card, Wells Fargo credit card, Best Tag personal loan, okay? Credit limit, 5,000. The APR, 21.99. Balance owed, 1,000. Monthly payments charge, 30 bucks. Monthly payments charge, that's how much this person being charged currently on that account. So for this given month, it's 30 bucks. Availability, we've learned from lesson 1 that the availability is the relationship between the credit limit and the balance owed. And that relationship calls for a subtraction operation. So 5,000 minus 1,000, that's how we arrive at 4,000 bucks. Credit utilization is the relationship between the balance owed and the credit limit. That relationship calls for a division operation. 1,000 divided by 5,000, that's how we arrive at 20%. Okay? Payment rates charged is the relationship between the monthly payments charged and the balance owed. That relationship calls for a division operation. $30 divided by 1,000, that's how we arrive at 3%. Okay? Now, on the Capital One credit card, they offer balance transfers, and the balance transfer is capped at 75% of the credit limit. Okay? The most you could go for balance transfer, 75% of the credit limit. Okay? And 0% intro APR for 12 months, and 3% balance transfer fees. Okay? On the Wells Fargo credit card, same thing. They offer 75% on balance transfers. So the balance transfer is capped at 75% of the credit limit. In this case, it's 3,000, 75% of 3,000. But on the APR is same as purchase, okay? So the APR gonna stay the same. It's not a 0% for the Wells Fargo now. It's not a 0%, it's not a 1.99%. It's gonna be the same as purchase, as the purchase APR, which is 1954, okay? But for the Wells Fargo, they do not charge any balance transfer fees, so it's at 0%, okay? For the Best Tag personal loan, right now we're on year 2 of 3. So it's a 3-year personal loan, okay? Right now we're already in year 2 of 3, okay? Now, this is a college student. These are some of his expenses, okay? So he has a part-time income. His part-time income is $1,620. His expenses, that's when you add all these expenses that we have on the board, all these amounts, okay? $1,220, and out of these expenses, $633.22 could go on a credit card, okay? $633, okay? So those will be these bills that could go on a credit card, okay? $633. The debt, that's when you add all these balances, 1,000 $4,558.97. We arrive at $7,558.97 for debt. Okay? And cash flow, we've learned from prior lesson that cash flow is the relationship between the income and the expense. And that relationship calls for a subtraction operation. So 1620 minus 1220, that's how we arrive at $400 cash flow. Okay? And again, folks, these are the college student. These are his bills, his expenses. Okay? The rest of the stuff that's not on the board, his parents takes care of the rest of the stuff. Okay? So he has electricity. The electricity is due on the 28th. Okay? The amount, $100. And electricity could go on a credit card. Okay? YouTube TV is due on the 28th. Amount $83 also could go on a credit card. Okay? Metro PCS cell phone is due on the 28th. The amount $50, and Metro could also go on a credit card. Okay? Groceries. Remember, we've learned from prior lessons that there are some bills, there are some expenses that do not have due date. Groceries do not have a due date. Okay? It's going to be $200 for the month, and groceries could go on a credit card. Okay? Fuel, gas, and again, another expense that do not have due date. $120 is the amount, could go on a credit card. Okay? Hair barber. Okay? This college student gonna get his hair done on the 14th, on the 28th of the month. So, but the family barber charge him $15 per haircut. So he's gonna get his haircut done twice, on the 14th of the month and on the 28th of the month. So 15 on the 14th, then $15 again on the 28th, for a total of $30. The family barber does not accept credit card. So he has to pay that expense with cash. Okay? Capital One credit card is due on the 4th, because remember from prior lessons, Capital One was one of the credit card where when you're trying to change the payment due date, say for the 28th, the 29th, say for the 28th, if you're going to be on auto pay, Capital One was not allowing us to get a 28 due date, okay? To get a due date for the 28th. In this case, the kid chose the 4th. Remember, I believe Capital One was one of the cards where they only give out, they only had like 4 dates available. I believe it was like the 4th, the 5th, the 8th, the 15th, or the 19th. And from prior lessons, the one in the middle does not apply. So we have to pick either the first number listed or the last number listed. And in this case, a college student choose the first number listed, that was the 4th, because we could not get a 28 due date that we wanted, a 29 due date that we wanted, a 30 and a 31 due date. Depends how many days we have in a month. Okay? So we know if you pick the 4th, which means we're going to pay the bill early, we're going to pay it a few days early for the month prior. So we could achieve a 28 due date, a 29 due date, a 30, or the 31. Because remember, in the alternative account, we want income to have an opportunity to come in first. We want expense to be towards the end of the month. And then we cover all of that from prior lessons. Okay? So Capital One due on the 4th, which means the college student gonna pay that bill early, like we covered, and the amount is $30. And this is where we get that $30 from. Okay? Wells Fargo credit card is due on the 28th. The amount $68.80, that's where we got the $68.80 from. Okay? Best Eggs due on the 28th, the amount $457.98, and this is where we get the $457.98 from. Okay? All right. Now, for the bills that could be paid on a credit card, the total is $63322. That's when you add all of these. 100, they all could go on a credit card. 100 plus 83 plus 50 plus 200 plus 120 plus 8022. That's how we arrive at that 63322. Okay? Now, this college student is on a part-time income. His paycheck for this given month gonna come on the 4th, is on a bi-weekly pay period. So which means the next paycheck gonna come 14 days later, which is on the 18th. So 4 plus 14 is the 18th. So 2 paychecks for this given month. One on the 4th, one on the 18th. Okay? Sometimes you could have 3 paychecks in a given month. And we'll probably cover that on another lesson. But for this month, he has 2 paychecks that comes in for the given month on the 4th and the 18th. The college student gonna take advantage of the balance transfers, and he's gonna try to execute the balance transfer on the 4th. Okay? So same day he got the first paycheck, he's gonna try to do the balance transfers. The credit card, we have 2 credit cards on the board. Okay? The billing cycle closes on the 4th at the end of the day. Okay? Closes on the 4th of the month for both of them. For the Capital One, the billing cycle, the statement cycle closes on the 4th. For Wells Fargo credit card, it closes on the 4th as well. Okay? All right. Now, question posed to me was, James, can you do an example whereby the debt with the highest APR is not a credit card? Okay? And that's exactly what we have on the board. The APR, take a look at the APR. We have 2199, 1954, 3599. So the debt with the highest APR is not a credit card. Okay? Best Egg has the highest APR, and Best Egg is not a credit card. So Best Egg is a personal loan. Okay? So that was the question posed to me. Okay? Do an example where the highest APR, the debt with the highest APR is not a credit card. Okay? So 3599, highest APR, and it's not a credit card, it's a personal loan. Okay? All right, America. I'll give you about 5-10 seconds to take a look of what's on the board, and then we're going to continue with the exercise. All right, America. So far, I've been receiving a lot of emails about folks showing interest and wanted to either get consultations or financial coach training or training for financial coach. Okay? And like I said in prior lesson, guys, right now, unfortunately, I am not taking on any new clients, and I am not doing any training for financial coaches. Okay? So when I decide to do that, I'll probably make an announcement, to let you guys know when I'll start taking on new clients, when I'll start doing training for financial coach. But unfortunately, as of right now, I'm not doing any of those two. Okay? All right. All right. Let's do a quick little revision with Ambroise Method 1.0. Okay. From past lesson, we talked about how Ambroise Method 1.0 calls for a series of steps that need to be taken at least once a month. Okay? And these steps are segregate, compare, transfer, repeat. Let's just go over the list real quick. Repeat. And there might be some condition, exception, restriction to the strategy. And then you're trying to stay above the line for as long, there goes the line. You're trying to stay above the line for as long as you can before you go downstairs, before you go below the line. And below the line, you have to answer some questions. Can we use cash flow, or can we make a large payment? Okay? Then after that, you have to answer the what. W-H-T, the what. Okay? Which account to use? how much of a payment to send, and to pay down or off which debt. That's the what. And again, real quick, the steps: segregate, compare, transfer, repeat, cash flow or large payment, and then the what. Which account, how much of a payment, to pay down which debt. Okay? These are the steps for Ambroise Method 1.0, and those steps has to be taken at least once a month. So, say for example, in January, you do these steps. In February, you do these steps again. In March, same thing. Okay? At least once a month. Okay? Now, let's run Ambroise Method 1.0. Okay? First, we have to segregate. And by the way, today, on the transfer, from past lesson, we've only been doing normal transfers. But today, we're gonna do what I call, for our purpose, mix and match balance transfer. That's for today. Okay? In the past, we've done normal balance transfers. Today, we're gonna do mix and match. And for those of you who missed that lesson, in the transfer part, we do transfer between current existing account when the transfer makes number or math sense. Okay? There goes our current existing account. Okay? So we use the same account that we already have. Okay? And a normal balance transfer, for our purpose, is a transfer between same account type. Okay? So, for example, a revolving with a revolving. That is a normal balance transfer, transfer between same account type. A mix and match balance transfer, for our purpose, is a transfer between different account types. So it could be an installment and an installment credit account and a revolving credit account. Okay? So that's why we call it mix and match. So for our purpose, that's what mix and match means. Okay? All right. And this is for the folks who missed that lesson. And again, guys, today we're doing lesson 7. The way I want you guys to watch this lesson. Watch lesson 1 before you watch lesson 2. Watch lesson 2 before you watch lesson 3, and so on and so forth. Okay? So, we're on lesson 7 today. All right. Since today we're going to be doing a mix and match balance transfer, that is a transfer between different account type. And on the board, we got some revolving credit account. These are the 2 credit cards. And on the board, we have an installment credit account, which is the personal loan. Okay? There are some restrictions, America, when you're trying to do, for our purpose, a mix and match balance transfer. Okay? Some of the restrictions is that the account cannot be from the same lenders, the same creditors. Okay? So if you're trying to move money balances from the Best Tech personal loan, you cannot move it to the Capital One if they are the same lenders. So in this case, personal loan is not the same as Capital One. Best Tech personal loan is not the same as Wells Fargo. So they are not the same lender. And not only that, they cannot be the same affiliate. Okay? They cannot be the same creditors or lenders. They cannot be the same affiliate. Okay? So if Best Tech has any kind of relationship with Capital One, you cannot do that kind of balance transfer. If Best Tech got any kind of relationship with Wells Fargo, they will not allow you to do that kind of balance transfer. Okay? So cannot be the same lender, cannot be the same creditors, cannot be the same affiliate. Okay? These are some of the restrictions when you try to move, say for example, you try to move money from a personal loan to a credit card, okay? All right. All right, now, let's go back to running Ambroise Method 1.0. First, we segregate, okay? And we segregate by same account type. So that's looking at the list of that. Capital One is a credit card, Wells Fargo is a credit card. So all the revolving together, revolving credit account, and all the installments together. In this case, we only have three. The list is perfect because we have all the revolving together, the credit cards are together, that's revolving credit account. Then we have that one installment that's by itself. So segregate is already done for us. Okay? To save time, I've already segregated the list. Okay? Next, America, we compare. And how do we compare? We compare by APR. Okay? So, and I prefer the highest APR on top and the lowest APR at the bottom by account type. So by account type, we got two credit cards. And I prefer the highest one on top. So 2199 is bigger than 1954. So it's already, I've already arranged the list for you guys. Okay? By account type. The best egg is 35, but it's a different account type. So we have the best egg at the bottom by account type. That's how we compare. Okay? So I rearrange the two by account type. And best egg is a different one. If there were more best eggs, more personal loans or more installment credit account, we have them at the bottom. And we'll rearrange them by account type, highest to lowest, okay? So these two are perfect. So the list is perfect, okay? So compare is already done. And again, by account type, not by APR, but by account type. That's how we compare, okay? Next, we'll transfer, okay? And the way we do our transfer, America, we transfer from, we relocate balances from the highest APR. Now this is global now, that's all of them. From the highest APR, the highest APR is the best egg one, 35.99. So we want to relocate from highest APR to the lowest APR. The lowest APR is 1954, okay? So, let's try to relocate. Let's try to do the transfer. And again, today we're doing a mix and match transfer. That's a transfer between a personal loan and a credit card, okay? Wells Fargo is offering balance transfer. The transfer is capped at 75%. So let's figure out what that is. So for Wells Fargo, it is 3,000. Remember, it's capped at 75%, okay? So times 75%. Let me grab my calculator real quick. So 3,000 times 75%. So we have 2,250 bucks. Okay? That's the max you could go. But the college student already, this young man already owe 2,000. So he already has an existing balance of 2,000. So 2,250 minus the 2,000. So the most that he has available for balance transfer is only 250. Because when you do 2,250 minus 2,000, we should arrive at the 250. Okay? So this is what we have so far, okay, to do balance transfer with. Okay? And again, our first transfer, gonna be We're trying to relocate balances from the higher APR, because remember, our method, we hate to have to babysit balances from higher APR. So for that reason, we're always trying to relocate them to the lower APR, okay? To a lower interest rate environment. Okay, so now we have 250, okay, that we could use, okay? So let's execute the balance transfer then. In this case, we're not touching Capital One as of yet. Right now we're doing Wells Fargo and Best Egg, okay? So Capital One's gonna stay the same. $5,000. The APR, 21.99. %. The balance, again, we're not touching Capital One as of yet. 1,000, 30, 4,000, 20, 3%. Okay? Now, we did say we're going to touch Wells Fargo. So Wells Fargo, credit card, 3,000, 1954, 2,000. Now remember, we're gonna go all the way to the max allowed, which is 2250, because we're taking advantage of the balance transfer, which is 75%. So now the balance for Wells Fargo is gonna increase from 2,000 to 2250. Okay. The monthly payments charge, now the monthly payments charge is going to change because the balance changed. The balance went higher, the monthly payment charge is going to go higher. And for payment, they charge them 3.44%. So now we have 2250 times 3.44%. 77, 2250, 77.40. Okay? The availability is credit limit minus balance owed, so 3,000 minus 2250. So we are at 750. Okay? Credit utilization is balance owed divided by credit limit, so 2250 divided by 3,000. So we are at 75%, which is the cap on the balance transfer. Okay? And the payment rate charge, we know it's 3.44. But let's run it just for good measure. It's going to be the monthly payment charge 77.40 divided by the balance owed, which is 2250. Sure enough, we have 3.44%. Okay? Now, we did say we're gonna touch Best Egg. So Best Egg. Okay. 10,000 credit limit. Well, original amount. APR 35.99%. The balance owed. Now, we did say we're gonna send 250 to the Best Egg because we're gonna relocate some of that balance into the lower APR account, which was Wells Fargo. So 4558.97 minus the 250. So now, so far we're at 4308.97. Okay? And Best Egg is a personal loan. The monthly payment charge doesn't change. Okay? because it's a personal loan. So it's still going to be $457.98. That's the principal and interest portion. Okay. The availability is credit limit, 10,000. But in this case, it doesn't really matter because it's a personal loan. Okay. And the credit utilization, and again, Best Tech is a personal loan. The credit utilization doesn't matter. Okay. And the payment rates charged, we do it just for good measure. Should be the monthly payments charged for $57.98. Divided by 4308.97. It should be at 10,628,629. Okay. Now that was on the first transfer. On the first transfer, we relocate balances from the higher APR into the lower APR. So that's why Best Tech went down from 45 to 43. It went down, and Wells Fargo went up from 2,000 to 2,250. Okay, that was the first transfer. And then, as far as the steps for Ambroise Method 1.0, let's see if there's an opportunity to repeat the transfer. Okay. Now remember, now we're done with Wells Fargo. Now remember, Capital One is also offering balance transfers. Okay, and Capital One is at a lower APR than Best Tech. Of course, we're going to try to relocate balances from the higher APR into the lower APR. Okay, so for that reason, the transfer makes sense. We're going to do transfer. So now, we're repeating now. Okay? And we are right here now. So, let's find out our numbers. Capital One was 75% cap. So let's find out how much that is. For Capital One, we have 5,000. But the balance transfer is capped at 75%. So for Capital One, so 5,000, there goes the 5,000, times 75%. Because remember, they're all capped at 75%. So 5,000 times 75% is 3,750. But on the Capital One, the gentleman already owed $1,000. So minus the 1,000. So now all you could use is 3,750 minus 1,000, so 2,750. Okay? All right. So now we could use 2,750. We could relocate balances from the Best Tech. Okay, by 27, we could reduce it by 2,750, and that's exactly what we're going to do. So now, Capital One. And again, this is the second transfer when we're repeating balance transfer. Remember, we'll keep doing transfer if it makes sense. Okay? And we're trying to stay upstairs for as long as we can. If there are opportunity to do more balance transfer, we'll continue to do balance transfers. Okay? So 5,000. Okay? All right. The APR for Capital One, we're here now, 21.99. Balance owed for Capital One used to be 1,000, but remember we want to go all the way through the max, so 3,750. And again, that's 1,000 plus the 2,750, 3,750. Okay. the monthly payments charge, where am I? I'm right here. Monthly payments charge. Capital One was $30. Now the balance went up, which means the monthly payments charge is gonna go up. And how much do they charge? In the case of a flat rate, they charge 3% on the Capital One. Okay? So $37.50 times 3% to find out what the monthly payment is gonna be. $37.50 times 3%. So now we're at 112. It would have been, well, tentatively 112. Actually, on the Capital One, I almost forgot, they charge 3% fee of the balance transfer. So if the balance transfer is gonna be $2,750, so let's figure out how much the fee is going to be. Remember, it's 3% fee. Okay? So we're trying to transfer $2,750 times 3%. Let's see how much that is on the fee itself. $2,750 times 3%. So now we're at $82.50. Just the fee itself. So the fee, let's put it right here, is $82.50. Okay? So now the new balance now gonna be the $37.50 plus the fee, because it wasn't free. They charged 3% to do that balance transfer. Okay? So you have to add the fee to the balance. So $37.50 plus the $82.50. Okay? So now we're at $32.50. Okay? That's the new balance. And again, we're going 75%, which is the max, okay? Minus what you already owe, which is $1,000. So we have $2,750 to transfer. Of the transfer amount, they charge 3%. So $2,750 transfer amount times 3%, $87.50. Okay? So you'll be the $2,750 plus the $82.50 plus the $1,000 that you already owe. Okay, altogether we should be at $32.50. And again, let's run it again for good measure, just making sure I didn't make any mistake. $2,750 plus the $82.50 plus the $1,000 you already owe. Perfect. $32.50. Okay. Now, 1, 2, 3. 1, 2, 3. Now the monthly payments charge. Balance went up, monthly payment charge is going to go up. Well, how much was it for Capital One? It's 3%. Okay? So $32.50 times 3%. Okay? So we should be at 11498. Okay? For monthly payment charge. All right? Now the availability is credit limit minus balance owed. Okay. So 5,000 minus balance owed $38.32.50. $38.32.50. Availability now is 1,167.50. Okay. Credit utilization is balance owed divided by credit limit. So $38.32.50 divided by 5,000. So now we're at 65%. The reason why it's not at 75%, because remember, we've only used up to 75%, but you have to add on the fee that was charged. So that's why it's a little higher than 75%. Okay? And payment rate charge, obviously the payment rate charge gonna be 3% of that amount, but let's run it just for good measure. Payment rate charge is monthly payment charge 114.98 divided by balance owed, which is 3832.50. Okay, sure enough, we got the 3% that we know it was. Okay, all right. So that was capital one on the second transfer. The Wells Fargo, we've already touched the Wells Fargo, so we're here now. Wells Fargo stays the same. So 3,000, 1954, 2250, 7740, 750, 75%, and 3.44. Okay? And now the best egg. Okay. 10,000. 35.99%. 4308. Now remember, this is the current balance, but we're gonna send 2750 from the capital one, okay? Because we're gonna relocate 2750 out of the 4308. Okay? So 4308 97 minus 2750. So now we are at 1558.97. Okay? Monthly payment charge, and again, best egg is a loan, so the principal and interest portion is gonna stay the same. 457.98. Okay? The availability doesn't apply because it's a personal loan. The credit utilization doesn't apply because it's a personal loan. And the payment rate charge, let's do it just for good measure. 457.98 divided by 1558.97. Okay, and again, the payment rate charge is the relationship between the monthly payment charge and the balance owed, and that relationship calls for a division operation. Okay, so now we should be at 29,377. Okay. All right. To recap, we've done two transfers. The first transfer, we relocate 250. Okay. From the best egg to the Wells Fargo. Okay. So the best egg went down by 250, so from 45 to 43. So the Wells Fargo went up by 250, from 2,000 to 2250. That's the first transfer. On the second transfer, we relocate balances from the best egg, okay, by 2750. So the best egg got lowered again from 4808 minus 2750. So now we're at 1558. Okay, so which means the capital one went up by 2750. So he was 1,000. He went up by 2750, which was 3750, plus the fee, 8250. So that's how we arrive at 383250. Okay? All right. Now we've done one, we repeat one time. Is there more opportunity to repeat? Because remember, we're trying to stay above the line, America, for as long as we can before we go downstairs, which is below the line. Okay? So this is where we are. We have capital 1, 5,000, 3830. Let's take a look at the availability. The availability is, these are these numbers. Okay? 1,167.50. Availability from Wells Fargo is 750. Okay? Can we relocate more or part of the 1558, which is balanced on a higher APR? Can we relocate some of that to a lower APR? Okay? There is opportunity to do more balance transfers. However, you guys haven't learned that lesson yet. I haven't covered that lesson with you guys yet. Okay? Because remember, these are all the different balance transfers we could do. Normal. Well, in this case, it wouldn't be normal because we have revolving and installment. Mix and match. In addition to these, from the bank, these are from the big bank, the big creditors. Big banks, big creditors. Okay? These guys. Okay? But remember, America, we are not handicapped by what the big bank, the big creditors could do for us. We could still execute our own balance transfer where we do not need the help of the big bank, the big creditors. Okay? So, we could still do more balance transfers if there's opportunity to do balance transfers. Okay? If it makes sense. In this case, we have availability 1,167.50 and we have availability of 750. Okay? From a lower APR account. 2199 in 1954 is lower than 3599. Okay? But since you haven't learned how to do artificial balance transfers yet, because I haven't covered that lesson with you guys yet, okay? As you could see, America, my method is very aggressive. Okay, we transfer. We don't stop transferring, okay, if the numbers math still makes sense. Okay? But the only reason why we'll stop right here, because we haven't covered that lesson yet, which is artificial balance transfers. Okay? Because remember, on our method, we have different types of balance transfer. We have normal, artificial, and in the artificial one, we have Ambroise charge pay technique, normal, Ambroise charge pay technique, inducement, and we have plastic, Melio, or similar entities. Then we have mix and match. So far, you've learned how to do normal balance transfer. So far, today, you've learned how to do mix and match balance transfer. You haven't learned how to do artificial balance transfer yet. Okay? And again, Ambroise charge pay technique is a technique whereby you could still execute balance transfer where you fired the big bank, the big creditors. Okay? You don't need the help of the big bank, the big creditors in order to execute balance transfers. And we have two variations of it, America. We have normal. This one's going to cost you 0% in fees. The normal one. And we have inducement. The inducement one, you still don't need the help of the big bank, the big creditors, but it's going to be a fee that is lower than what the big bank, the big creditors are charging. So if the big bank, big creditors are charging 3 to 5%, okay? And the inducement one, you need to be anywhere between 0.01 to 2.99, which is lower than what the big bank, the big creditor is charging, okay? And finally, we'll do plastic, okay? So, up to this point, you probably are proficient in Ambroise Method and how to run Ambroise Method 1.0 by, I'll say maybe 60 to maybe 70% proficiency. Okay, 60 to 70% proficiency. Okay, that is because you don't know how to do the other stuff yet. Okay, you haven't learned how to do Ambroise's charge pay technique yet. No more Ambroise charge pay technique yet, inducement, and you don't know how to utilize plastic yet because I haven't covered this lesson with you guys yet. Okay, so and 60 to 70% proficiency, you still are ahead of a dead snowball, even at 60 to 70% proficiency, ahead of a dead snowball. You are still ahead of a dead avalanche. And you are still ahead of a velocity banking of these groups. Even at 60 to 70% proficiency. Okay? As you could see, the other debt repayment method will never, ever be able to compete with our method. Okay? This is worst case scenario for us, for college students that don't quite fully know how to run Ambroise Method 1.0 because we haven't done that lesson yet. Okay? Someone who's just learning how to run Ambroise Method 1.0 will still do better than that snowball group, will still do better than that avalanche group, will still do better than velocity banking group at 60 to 70% proficiency. Okay? All right? All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Now, earlier we execute a balance transfer and our interest rate, we took advantage of the balance transfer intro APR, especially on the Capital One. Okay. Let's find out if that balance transfer did make sense. Okay. So in other words, we're going to be comparing balance transfers versus cash flow. Okay? Now, on the Capital One, when we relocate 2750 from a higher APR to a lower APR, let's find out how much we saved for that given month. Best egg is at 35.99%. So when we relocate 2750, figure out our numbers. 2750 times 35%, 35.99%. We're trying to figure out how much we save for the month. Divided by 12, okay? Because before we did the transfer, that's how much 2750 would have cost us, okay? So 2750 times 35.99% just the interest portion, divided by 12, we are at 82.48. Okay? That was before we did the transfer. That's how much in interest we would have gotten charged for the month, 82.48. Now, because we take advantage of the balance transfer at 0% APR, well, let's find out how much we're saving for the month. So, again, same 27.50, and this one was best egg, and this one is capital one. Times, what's the new interest rate that they're charging us? The new interest rate they're charging us is 0%. Okay? So it did not cost us anything. So 37.50 times 0%. So now we're at 0. Okay? So in essence, divided by 12, in essence, for the month, America, we save the 82.48 minus the new charge, which is 0. So we save 82.48. So for doing a transfer, that's how much we save for the month. While it would have cost us if we kept this 27.50 inside the best egg, okay? And what it cost us for moving the 27.50 to the other account. But since we took advantage of 0% APR, so the other account is at 0. Okay, it's not always 0, but in this case it's at 0. Okay, and the difference, okay, from the monthly payment charge, from the monthly interest charge, between the two monthly interest charge, the difference is 82.48. Okay. And again, we try to compare real quick balance transfers with cash flow. Because some of the other methods, remember, they only use cash flow. Okay? So, if we were using debt snowball and debt avalanche, because these two are the only one that uses cash flow. Velocity Bank can do chunking and they use a debt weapon in addition to cash flow. So we're going to kind of leave Velocity Banking out of this equation for now. Okay? So for debt snowball and debt avalanche, because these two uses cash flow. And again, we're comparing in balance transfers with cash flow. Okay? Debt snowball, we want to send cash flow, which is $400, to the lowest APR account. So 400 will go, lowest balance account will go to the 1,000 because these are the original amount. Okay, so that snowball will be 400 times 21.99% because that's how much they're charging. 400 times 21.99%. Okay, because remember that snowball will send payment to the lowest balance, and the lowest balance they charge 21.99. So that's exactly how much you save. Okay, you save what they're charging you, 21.99. Okay, because we're in the interest portion over here, the interest cost. That's what we're concerned about for now. So 21.99% divided by 12 for the month. So that snowball would be the 400 times 21.99% divided by 12. So that would be $7.33 in interest cost savings. Okay. $7.33. Okay. Now let's do that avalanche real quick. That avalanche, we want to send cash flow, $400 to the higher APR. In this case, the answer will be the same because the higher APR is also the lower balance. So they would have the same results as that snowball, which is 733. Okay, from the original example. Okay, because remember, these folks, that avalanche group, this group wants to send cash flow to the higher APR. Okay, in this case, it so happened that the higher APR is also the lower balance. Okay, from the original example. Okay, so same thing, 733. All right. So as you could see, America, if you're sending cash flow to these accounts for the month, for both that snowball group and that avalanche group, you would save 733 compared to when you're doing balance transfer. Okay? And we're only talking about the one of the balance transfers. Okay? The one for the capital one. The Wells Fargo one, we're not even added it to it. So there'll be more savings. Okay? So now we're only talking about one of them. Not both of them combined. Just one transfer, we're at 82.48. And these guys will be saving for the month 7.33. Okay? So which one, America, would you rather have? Okay? A method that'll save you from the get-go 733 in the beginning, and one that'll save you 82.48. Okay? Let's see how many times is that. That's more than 11 times. That savings. As you could see, why transfer is extremely important, America, instead of using cash flow. Cash flow is too small. Does not go far enough in eliminating debt quickly. Okay? If I just use cash flow to send towards debt, this is all I'm saving. When I could take advantage of transfers, whether the bank, whether the big bank, the big creditors, okay, offers balance transfer or not, we'll still execute balance transfers because, again, our method, we are not handicapped by what the big bank, the big creditors could do for us. Okay, we could still execute our own balance transfers without the help of the big bank, the big creditors, by employing those artificial type of balance transfers, whether it's Ambroise charge pay technique normal, Ambroise charge pay technique inducement, or plastic Melly or similar entities. Okay? This is why on our method, transfer is first before cash flow. Look at our tab. The T for transfer. The A, which account, that's the alternative account. And to pay off which debt, that's where the T resides, the C resides. Look at our tag. Cash flow is last on our list. Cash flow is not first on our list. Okay, transfer is first on our list. Okay, and we prove it here. The balance transfer is more beneficial than cash flow. Doing the balance transfer, I save 82.48. Not even taking into account the Wells Fargo one. This is just for the capital one. I'm saving 82.48 for the month. Using cash flow, I'm only saving 7.33 for the month. So which one is bigger, America? 82.48 or 7.33? So 82.48 is bigger. That's from doing transfers. Okay? And again, balance transfer in our method, balance transfers and cash flow, they are not in competition with each other. Okay? They work in concert with each other. They work in conjunction with each other. See, we still got transfer, we still got cash flow on our method. Okay? They work in conjunction. Okay? They are members of the same body. This is the body, our TAC. Transfer, alternative account, and cash flow. Okay? They are members of the same body. Transfer is still members of the same body. And cash flow is a member of the same body. And the body, I guess, would be Ambroise Method 1.0. Okay? Or the assignment, the element, or the jobs. Okay? And again, transfer, majority of the time, will be more beneficial to do. And even when it's not, remember, they work in concert with each other. They work in conjunction with each other. They work together. They're not in competition with one or the other. But if they were in competition, in this particular example, transfer will be more beneficial to do. 8248, 733. Okay? Because I see these other groups that think that improving their cash flow position, they think it's more important than improving your APR position. When we're trying to relocate balances from the from the account with the higher APR, we're trying to relocate these balances to the lower APR. Okay, doing that is more important. But these other debt repayment group, they think that cash flow, okay, especially debt snowball, because these people wants to attack the lowest balance first, and some factions of velocity banking. Because remember, from prior lessons, we described three. This group, they do not have a cohesive message. We have kind of like three separate groups inside velocity banking, or at least three separate groups. We have one bragging about paying off mortgage faster. We have another one bragging about cash flow recovery, which is opposite of each other. And we have the other group that are like salesmen. We cover all that from prior lessons. Okay? So the debt snowball wants to use cash flow, and some factions of velocity banking that also wants to use cash flow. These guys talking about cash flow recovery. And again, America, when you're paying off debt, the standard, the barometer is the APR. Okay? Not how much cash flow you could get. Okay? The standard, the barometer, the measuring stick is the APR, is to work on the APR, not the cash flow. Okay? All right? So now, this is where we start. You know what? Let me give you guys about 5-10 seconds, and then we're going to continue with the exercise. All right. So as you could see, when I was briefly comparing balance transfer versus cash flow, one of them will give you 8248, one of them 733. Okay? And again, cash flow is considered much less important. So improving your cash flow position is considered much less important than improving your APR position via transfer, via payments, via movements. Okay? All right. So let's figure out how much our cash flow got increased for our method. And it's sometimes for our method, cash flow gets decreased. So for our method, this is where we are initially on the monthly payments charge. So these three accounts got affected because we did multiple transfers, every account on the board got affected. This is what our original monthly payment was. $30 plus 68.80. We're here now. Plus 457.98. Okay? And this is where we are on the monthly payments charge. So minus the three accounts that got affected, 11498 minus 7740 minus 457.98. Okay. Now for cash flow, instead of our cash flow to increase, our cash flow decrease by 93.58. Remember, this is where we are on the monthly payments charge. So when we do the three accounts that got affected, originally that's where we were. So 30 plus 68.80 plus 457.98, okay? Minus the new amount on the monthly payment charge, 114.77.40 for 57.98, okay? So our cash flow got decreased by 93.58. Remember, our cash flow was 400. So now you would be 400. This is our new cash flow. Minus 93.58. So now we are 306 because our cash flow got decreased by that amount. We are 306.42. Okay? That's our new cash flow amount. Just to prove, I create this example, America, on purpose, just to prove to the other group, the debt, especially the debt snowball and some fraction of velocity banking. Initially, our cash flow was 400 bucks. Now our cash flow went down to 306.42. As you could see, when the other debt repayment method, these groups are misinformed, thinking that you have to improve your cash flow position. Okay? And again, I create this example on purpose to show them that you don't have to improve your cash flow position. In our example, we went the other way around. We make our cash flow position get worse. From 400 to 306.42. Why? Because we understand that when you're paying off debt, America, it's the APR, okay, position that you need to improve, not your cash flow position. Our cash flow got worse from 400 to 306.42. Okay? And again, America, when you're paying off debt, improving your cash flow position is considered much less important than improving your APR position via transfer, balance transfers, via payment, where we make extra payment to the higher APR account, via movement, okay? When we have movement of incomes and movement of expenses, because you know movement of income and movement expenses gonna reduce the overall effective rate of that account. Okay? So improving cash flow versus improving APR position. Okay? When you have these two, improving your APR position is much less important. Much more. This one is much less. Okay? Now, I want to take my time today to kind of go over this because some of the other debt repayment group, they want to keep working on cash flow, trying to improve their cash flow position. Okay? And again, America, I create this example on purpose okay? Just to prove to these guys, okay, that improving cash flow is not as important. That is why, I make my cash flow position worse. Just to prove to them that improving your APR position via transfer, via payments, via movements. Okay? And these folks, some of them know how to run numbers. They could go ahead and run the numbers on the original one, doing dead snowball, on the original one, and using velocity banking as well, and using our results to see which method, okay, gonna go past the finish line first. Okay? Look at us. We do not want to, like the other debt repayment group, we do not want to babysit balances from higher APR. That is why we're trying to reduce the 45.58 all the way to 15.58. Okay? And by doing so, because Best Tech is an installment loan, remember, you don't get no relief on the cash flow portion when you're dealing with a personal loan. With a personal loan, you have to completely wipe out the personal loan in order to get relief on the cash flow side, on the cash flow portion. So the cash flow doesn't increase, okay, because the monthly payments stay the same on a personal loan, okay? Meanwhile, the other account, since you're doing transfer, the other account balances keep going up, keep going up. So now you have more expenses. So that's why your cash flow position, okay, get worse. Because by doing these transfers, the other account, the monthly payments charge went up on the other account. This one went from 30 to 114. This one went from 68 to 77. So you have more expenses now. But the Best Tech personal loan, the monthly payment doesn't change. And it will not change until you completely pay off that account because it's a personal loan. So for that reason, the cash flow position is gonna get worse. Okay? And again, to my financial coach or financial coaches in America in general, okay? Improving your cash flow position is much less important than improving your APR position via transfer, via balance transfers, via payments, via movement of income and expenses. Okay? And again, folks, especially to the financial coach in America, every single one of you guys, the APR, when you're paying off debt, the APR is the standard. The APR is the barometer. The APR is the measuring stick. Not how much cash flow you could get, whether up and down. And again, cash flow is much less important. Okay? I think I beat over this hard enough. And again, America, we are Ambroise Method 1.0. That is why the other debt repayment method would never be able to compete, because these guys are misinformed, doesn't know that when you're paying off debt, which aspects is the measuring stick, is the standard, okay, is the barometer, okay? We don't make this mistake over at Ambroise Method 1.0. Not only are we doing everything else better than them, not only are we doing revolutionary things, okay, but we also understand the standard, the barometer, the measuring stick, which is the APR. Okay? And just to put some fear inside the other debt repayment group, I created this example, okay, to show them. They think cash flow is more important? Well, I'm going to create an example where I make my cash flow position worse, just to prove to them that cash flow is not that important at all. Thank you, Jesus. Thank you, Lord. All right, America, I'll give you 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Erase some stuff. Now, earlier we did the balance transfer and it did cost us $82.50. Okay? And for doing the balance transfer, especially on the Capital One, we saved, I erased it, we saved $27.50 times $35.99 divided by 12. We saved $82.43. So we saved $82.43, 47.7, and the transfer was not free. The transfer did cost us $82.50. So now, how long to recoup? How long to recoup the fee? Because remember, this balance transfer did cost us something. It cost us $82.50. But every month, remember on the best egg one, we're saving per month $82.47.7. I erased it earlier, but let me put it on the board real quick. It was the $27.50 times $35.99 divided by 12. That's how we arrive at the $82.47.7. And that was the best egg. And the Capital One was the same $27.50 times 0%, because remember now Capital One goes at 0% for balance transfers. Okay, so that's how we arrive at this $82.50, $82.47. Okay, but this is how much we're saving per month, but it did cost us $82.50. So how long to recoup the fee? So it's the fee divided out by how much we're saving per month. Okay, so let's see how long that's gonna take us. $82.50 divided, obviously you could see it's less than 1 month, but let's do it just for good measure. So it should be 1.00002. Okay, so in less than 1 month, whatever fee, the 3% fee that Capital One was charging us, in less than 1 month for doing a balance transfer, we're going to recuperate, we're going to recoup the fee. So obviously that was a good balance transfer to execute. Okay, on 1 month, we already pay off whatever fee that was charged. Okay, and again, to recoup, it is the fee that's being charged divided by how much interest you are saving for the month. Okay, and this number we did not even take into account the Wells Fargo one, because we're also saving the Wells Fargo, but the Wells Fargo is at 0% fee, so there was no fee in the Wells Fargo. Okay, so it should really be less than 1 month. Okay, so that was a good transfer to execute. All right, now from prior lessons, I mentioned to you guys how Ambroise Method 1.0 is a very aggressive method. Okay, after we identified the enemy, which was in this example best egg personal loan, 35.99%. Because Remember, this is our barometer. That's our measuring stick, the APR. So the higher APR is the enemy. The higher APR is the troublemaker. 35.99. So what do we do to it? We attack in it. So attack, 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 attack via transfers. Okay, so we did 2 of them. Okay, just so we could reduce that balance from 45 to 1558. Okay, as you could see, we do not like to babysit like the other debt repayment groups are doing. We do not like to babysit balances from a higher APR account. That's why we attempt to reduce it. Okay? So, in essence, what we're trying to do, we're trying to overwhelm the debt, which is best debt personal loan. Okay? We're trying to attack it, attack it, attack it, trying to overwhelm it. Okay? We're trying to bring best debt personal loan to submission. Okay? We want these guys to, in essence, get on their knees and say, okay, Ambroise Method 1.0, you win. Okay? Because remember, this 35.99 is the reason why you are part of that statistic. Living paycheck to paycheck because you have so much of your income going towards interest. Can I even come up with $400 emergency? Remember, in one transfer, we were able to save 82, close to 82.50. So remember how soon you're gonna achieve 400 bucks. If every month, at least, bare minimum, you're saving 82.50. Okay? And again, our method at America is a very aggressive method. Excuse me. We don't toy around with the debt. We aggressively go after the debt. Okay? All right. Now we're done running Ambroise Method 1.0. We've completely done everything that were above the line. And the reason why we stopped, we still have availability. The reason why we stopped is because you guys haven't learned, like I before mentioned, how to employ Ambroise's charge pay technique yet. And you guys don't know how to employ plastic yet. Okay? So for now, we are done. Okay, maybe this is gonna be part 1. Maybe I will do a part 2 of that example after you guys learn how to Ambroise this charge pay technique. Okay? So now, since we're done upstairs, we have to go downstairs. Is to ask the questions. Can we use cash flow or can we use a large payment? Okay? For cash flow, we know now we are at 306.42. Large payment. Okay, the young man did not receive any bonus checks. The young man did not receive any income tax refund yet. The young man did not receive any kind of additional money. So there's no large payment. So we're going to be dealing with cash flow. Okay? So we are here now. We're downstairs. So we have to answer the what? Which account? How much of a payment to pay off which debt? Okay? But before we do that, let's find out which account is going to be our first in line alternative account or the account that offers a greater result in terms of reducing interest cost. Okay? So, first in line / greater results in reducing interest cost. Obviously, from past lesson, we've learned that the account okay, The account that has the highest APR gonna offer a greater result in reducing interest cost, in terms of reducing interest cost. So that account gonna be Best Egg Personal Loan. Okay. And for our method, we always look for the account that offers greater liquidity. Okay. So next in line, alternative account. But in this case, the first one, Best Egg is not an alternative account, but that's okay. Either the first in line alternative account or the account that offers greater results. Okay, doesn't always have to be an alternative account, because Best Egg is a personal loan. It's not an alternative account. So the next in line alternative account or the account that offers greater liquidity. Okay, so let's find out which account is going to be. Okay. So on the board, we have Capital One. And for bills that could go on a credit card, it's only 63322 when the expense is a lot higher. Then we have Wells Fargo, that's also a credit card. And again, expenses that could go on a credit card is 63322 when then the expense is a lot higher. And Best Egg. Now, we know that Best Egg is a personal loan, so Best Egg cannot give us greater liquidity. The other two credit cards are credit cards, and we are limited as to what could go on a credit card. So this account cannot give us greater liquidity. So now, America, the account that's going to give us greater liquidity is the checking account. All right. So we always look for greater results. That's the account with the higher APR. In this case, that's Best Egg. Best Egg has is 35.99%. Greater liquidity. Well, credit card can offer greater liquidity in this particular example because only 63322 could go on a credit card. So in this case, checking account will offer us greater liquidity. Now, what then are we going to do with the 63322 of these expenses that could go on a credit card? Okay? Remember from past lessons, I believe it was lesson 3, okay? When we employ Ambroise's wash technique, okay? So in the alternative account, where the same amount of income that comes into the alternative account is the same amount of expenses that go out of the alternative account. And the effective rate of the alternative account still got reduced. Okay? So we'll still use the credit card for movement. So for movement, it's going to be the credit card. But which credit card, James? Because we have 2 credit cards on the list. We have a Capital One and we have a Wells Fargo. Okay? The Capital One is at $21.99, but with balances of $3,832, but part of that balance is at 0%. Okay? So the Capital One, America, will treat the Capital One because the Capital One now has two different interest rates. Capital One has 1,000 at $21.99. And Capital One also have 2832.50 at 0%. Again, guys, if you're gonna use alternative accounts, okay, you gotta know what you're doing. Okay. This Capital One, we're gonna treat it as two separate accounts because he has two separate interest rates. Okay, so he has multiple interest rate. He has varying interest rate. A portion of that Capital One is at 21.99, and the other portion, which is the balance transfer portion, the portion that we execute a balance transfer with, is at 0%. Okay. And again, because he has two different interest rates, we're going to treat it as if it's two separate accounts. Okay? Well, James, how then will payment be allocated to the Capital One if he has two separate interests? Okay? America, based on the Credit Card Act, okay? When you send minimum payment only, the minimum payment will go towards the 0% APR portion. Any excess above the minimum payment, you could elect for it to go, whether automatically or not, you could elect for it to go towards the higher APR, highest APR. So the 21.99, so that will be any excess. For example, for this Capital One, if you only send in 114.98, well, the 114.98 gonna go towards the balance portion at 0%. Any excess above the 114.98, that's the monthly payment now, above any excess. So if you have 115.98, it's 114.98. So if you send 115.98, that $1 excess gonna go towards that 1,000 at 21.99%. That is the rule, okay? And the bank are in the driver's seat because all your payment will go first towards the 0% APR. See, that way they continue to earn interest on you. Because remember now, the minimum payment will go to the place where you receive no advantage. Meanwhile, you're still being charged $21.99. Okay? So the rule that our government set will work in a way to their favor. Because the minimum payment will go to where, it's at 0%. Any excess will now go towards the 21.99, which means if you keep sending just minimum payment, they'll keep charging you the higher APR. Okay? That's how it works when you have varying interest rate, when you have multiple interest rate in one account. Okay? Guys, my financial coach, you guys have to have that knowledge. Okay? And same thing, because sometimes it's not just two, sometimes you also have cash advance. So this one is the regular standard APR. Sometimes you also have cash advance. Okay? Then you could elect, because usually the cash advance is much higher than the standard APR. Okay? Then you could elect to have some of the money sent to the cash advance portion after you satisfy the minimum payment portion. Okay? That's how it works. Okay? Based on the Credit Card Act. And I believe it was in year 2009 or something. That's when they come up with that rule. Okay? All right. Now, because we're going to treat Capital One as two separate accounts, well, which account we're going to have movements in, we know we're going to have our movement in the account with the higher APR. Well, which account has the higher APR now? We have 1954, we have 0, and we have 2199. Okay? So between 1954, 0, and 2199, 2199 is a higher APR. So now, America, my financial coach, you guys gonna have movement in the higher APR, which is the portion of that capital one. So that'll be capital one. Okay. I wanted to take my time in this lesson to make sure that you guys fully understand the concept. Okay. So now for movement of income and expenses, it's going to be the capital one. Okay? And again, we want the movement of income and movement of expenses to go in the account with the higher APR. Okay? Between the credit cards. Okay? All right. So these are the main three accounts we're going to be dealing with. The account that gives us greater results, well, that's the account with the higher APR, best egg. The account that's going to give us greater liquidity, well, none of these guys give us greater liquidity, so the checking account is going to give us liquidity. And we still want to have movement of income and movement of expenses in the alternative account so we could reduce the overall interest charge on that account even further. Okay, because remember now, we want to save everywhere. Every places that we could save money, we want to save money. So that's why we're going to have movement in the capital one. Okay? All right. To my financial coaches, as you guys watch more lessons, you guys going to fully understand the concept, okay, of how to properly use alternative account. Okay? So now let's figure out our numbers, James. Best egg, let's start with the regular minimum payment first. We know best egg is 4.5 monthly payment charge, 457.98. 457.98. Okay? Now, best egg will also receive the cash flow because cash flow is better served in the account with the higher APR. So cash flow of 306.42 will go to best egg. Okay? And there might be absorption opportunity for best egg. Absorption. Okay? The absorption part, let's leave it alone for now. Okay? Capital one, let's skip liquidity for now. Let's do capital one. Capital one will accept its own minimum payment, which is $114.98. Okay? That's the regular monthly payment. This is cash flow, this is absorption. Okay? Capital one will also accept the bills that could go on a credit card. Remember these bills. Okay? Which is $633 tentatively. $22. And again, these were the bills that could go on a credit card. And when you add them up, we're at $633.22. Okay? But from prior lesson, we've learned that we don't want any excess. Because remember, the monthly minimum payment for Capital One is only $114.98. We do not want, America, any excess to remain in the account with a lower APR. This one is only $21.99. In essence, we would be sending the combined payment to a lower APR. That is not how you achieve greater results in terms of reducing interest costs. Okay? For that reason, the best egg one, which is at $35.99, will absorb some of these amounts. Okay? Now, Capital One minimum payment is only $114.98. If we have $633.22 going to Capital One, well, $633.22 is greater than $114.98, which means, America, when you send $633.22 to the Capital One, you're going to satisfy that payment, which is $114.98, because you could find $114.98 inside $633.22. So for that reason, and again, we don't want excess to be in a lower APR account. We want any excess to be in a higher APR. So for that reason, we're going to relocate the $114.98 over here. So that would be our absorption opportunity. So Best Egg will receive an additional $114.98. Okay? So this will become 0. You see that? Trying to take my time today to explain that to you guys, so you guys will master, okay, at least in this example, this alternative account. And again, America, okay, we don't want our excess to reside inside a lower APR account, $21.99. We want any excess to go towards the higher APR account, which is $35.99, which is Best Egg at $35.99. Okay, that's how you reduce your overall interest costs on those accounts. Okay. Don't send payment, don't send too much payment to a lower APR account when you have a higher APR account on the board. Okay? So that's why we move it to the higher one. Once we satisfy the payment, and $633.22 will satisfy $114.98. Okay? Because $633.22 is greater than $114.98. Okay? All right. So now it's easy now to see what our checking account gonna receive. Because once we figure these numbers out, okay. So in total, Best Egg will get in total $457.98 plus $306.42, which is the cash flow, plus the absorption amount, $114.98. So altogether, Best Egg will get altogether $879.38. Okay? And again, $457.98, $306.42 plus $114.98, $879.32. Okay? We know that Capital One, so I'm here now, how much? $879.38. We know that Capital One will receive the $633.22, and the checking account, let's figure out how much the checking account will receive. The checking account will receive the difference. Remember, this young man, total part-time income is $1,622. So $1,622 minus $879.38 minus 63322. So the checking account will receive 107.40. Okay? So remember, we downstairs, we already did transfer, segregate, compare, transfer, repeat. Then we downstairs try to insert a what, which account. So we have best egg as the first in line, or greater results in terms of reducing interest costs. We have, for movement, we have capital 1, and for greater liquidity, we have the checking account. So these are which accounts. And then how much? Best egg 879.38, capital 1 833, checking account 172. To pay off which debt? Okay. We know the capital 1 gonna take care of every bills that could go on a credit card. We know the checking account. You know what? Let me give you guys about 5-10 seconds, and then we're gonna continue with the exercise. All right, America. And real quick though, remember the reason why Best Egg got to absorb the entire amount was because in this example, we knew the closing date on the credit card. The closing date was on the 4th, which means, and at the end of the day, and we made the balance transfer on the 4th. So at the end of the day, the balance hasn't changed, so we know exactly, how much our payment was, our minimum payment was going to be for both the Capital One and the Wells Fargo, okay? Because we knew when the account was closing. And to make the example a little easier, I use a flat rate, okay? Because sometimes different creditors, different bank uses a different method other than a flat rate. Sometimes they use a fee plus interest to arrive at the monthly payment charge. Anyways, I don't want to get too carried away with that stuff, okay? All right. So now we've determined our numbers on the what, which account, how much, okay? Let's now cover the workflow. Okay. The workflow. Remember, this young man receives a total income of $1620, and one will come on the 4th, and he's on the bi-weekly pay period. The next one will come on the 18th. So on the first paycheck, that's on the 4th, and we have the next paycheck that's on the 18th. Okay? On the first paycheck, now you got to pay attention to the due date. Remember, all these accounts could go on a credit card, all these accounts were due on the 28th. However, this young man has his family barber, okay, that accept cash. And he's going to get his haircut done on the 14th. It's going to cost some $15. He's going to get his haircut done on the 28th. It's going to also cost some $15. Okay? Now, on the first paycheck, let's start with, so paycheck touchdown his checking account. Where does the money go? The money goes to forgot to put the amount for the first paycheck. The first paycheck, let's assume they are equal. So 1620 divided by 2. The first paycheck on the 4th is 810. The next paycheck is also 810. That's how we arrive at that 1620. Okay, let's assume there were no overtime. Everything was equal. Okay. First paycheck touchdown is checking account. Okay. Where does the 810 go? Remember, we said that the best egg, which is the account that offers greater results, should receive 879.38. But the paycheck is only 810. $810 is smaller than 875.38. Okay? And not only that, his barber does not accept credit card. So you also have to account for the bill that's coming due. One paycheck is on the 4th, the next paycheck won't be until the 18th. But his barber wants cash because he's going to get his haircut done on the 14th. Okay? So now we have to reserve that $15. We have to keep it inside the checking account on the first paycheck because the first $15 is due on the 14th. But we won't get the next paycheck until the 18th. You see that? So the checking account will keep at least $15 because if you send it to the best egg, you will never be able to get it back. So you have to keep it inside the checking account. Remember, the 14th, so that paycheck will take care of bills that are due before the 18th. This bill is due on the 14th, before the next paycheck. Okay? Don't make the mistake and sending all the money in and forget to account for those bills that are coming due. His haircut will come due on the 14th, and the barber wants cash. So that cash has to remain inside the checking account. Okay? So which means the remainder now gonna go to the best egg. And how much is it's so best egg. Okay, so best egg will get $810 minus the $15. Best egg will get $795. Okay, that's on the first paycheck. That way you make sure all your bills are getting paid. Okay. The one without due date, we don't have too much information on them, so we kind of glance over them for now. Okay. But for items that we know, okay, checking account, $15 for first haircut, because barber wants cash. So, and the remainder will go towards the best egg. That's on the first paycheck. On the next paycheck, remember, best egg did not receive the whole thing on the first paycheck because best egg was $879. So best egg only got $795. So now best egg gonna get the remainder. So $879, because the total was $879.38 minus $795. So best egg now will get on the second paycheck $84.38. Okay? And capital 1, in that case, this is 0 on the first paycheck. So now, capital 1, remember we say capital 1 will get $633.22. So capital 1 now will receive $633.22. 63322. That's capital 1. Okay? And we did say that the checking account will get 107.40. So the checking account will receive 107.40 minus the 15. So the checking account will receive 92.40. Okay? All right. These are the numbers. Again, 810. So we got 92.40 plus 84.38 plus 633.22. That's how we arrive at the 810. Okay, on the second paycheck. Okay. All right. America, that is the workflow. Okay. Gotta know your numbers. Once you know your numbers, because remember, on the steps, you're trying to answer the what first. Okay? So once you answer the what, then you know exactly how to allocate funds from these paychecks. Okay? First paycheck, $15 stays in to take care of the haircut because you need cash for that. Best egg, because best egg is offer greater results, best egg will get $7.95. Capital One will get 0 because best egg offer greater results. Best egg is at $35.99. We want to send our payment to the higher APR account. Okay? And on the second paycheck, okay, these are the numbers. Okay? So the Capital One will pay all these bills that can be paid with a credit card. All these bills. The checking account will pay 15 bucks on the 14, 15 bucks on the 28. So if you were to break it down, the checking account will take care of that, which is 30, plus, remember it's 107.40. So it would be 107.40 minus the 30. So it'll be 77.40. Okay? So the 30 will be the haircut. The 77.40 will be the Wells Fargo credit card. Okay? And as soon as the payment touches down the Wells Fargo credit card, on the checking account, you have to send it quickly on the second paycheck now. You have to send it quickly to the Wells Fargo because on the checking, you're not earning anything or you're earning close to 0. Okay? But on the Wells Fargo, they're charging you $19.54. Okay? So you don't want to keep the funds inside the checking. You want to move it. As soon as you touch down the checking account, move it real quick to the Wells Fargo. Okay? Okay, so that takes care of that. So now all these got taken care of with the Capital One. And this one's, so the Capital One take care of these. The checking account take care of that. The checking account also take care of the new amount for the Wells Fargo because the new amount now are Capital 114.98. So these become 114.98. And this one becomes 77.40, and that one stays the same. So the checking account takes care of the haircut, and the checking account will take care of the Wells Fargo. Okay. The best egg will absorb the 114.98. And the best egg will keep the difference, which is the cash flow, 306.42, for a grand total of 879.38. Okay? All right, America. Hope you guys have a better understanding now on how to properly run alternative account or how to properly pay off debt in general. Okay, so I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America, as you could see on our method, we hate balances on a debt that has higher APR. We will always try to relocate it to a lower, better APR environment. Okay. Not only that, on our method, in order to facilitate relocating debt balances from higher APR account, okay, I devise multiple ways to execute balance transfers. Look at how many different type of balance transfer I have on my method. I have normal. I have artificial. Normal is 1. Mix and match, that's 2. Artificial, Ambroise charge pay technique, that's 3. Ambroise charge pay technique inducement, that's 4. Plastic, 5. Melio, 6. Similar entities, 7. As you could see, like I shown you guys earlier, okay, in the transfer versus cash flow, even though they are not in competition with each other, it's always best to try to execute transfer, balance transfer, balance transfer, balance transfer, whether or not the banks, the big bank, the big creditors offer you balance transfers or not. And in some instances, we don't even want to use balance transfers from offers on balance transfer from the big bank, the big creditors, because that balance transfer usually will cost you something. And you have to make sure that you recoup that cost. And sometimes it takes months to recoup the cost. Okay? In our example, we only take less than a month or a little over 1 month. Okay? So we're always trying to go for the free one first. While Ambroise charge pay technique is a free one. This one's not going to cost you anything. And Ambroise charge pay technique going to cost you between 0.001 to 2.99. So sometimes that's lower than what the big bank, the big creditors will charge you. Okay? Because the big bank will charge between 3 to 5, like I mentioned earlier. Okay? And again, America, when you're paying off debt, improving your cash flow position is considered much less important than improving your APR position via transfer, via payments. See, the best that absorb the minimum payment on the capital one, so via payment, and the best that absorb the cash flow, and via movement, and that was the movement. So when we have movements of income and movement of expenses on the alternative account, which was the capital one. Okay? And that's how, America, you pay off debt properly. Okay? Don't toy around with the debt like the other debt repayment methods are doing. Okay? You have to aggressively go after the debt. Okay? In this example, we're trying to bring BESTEC to submission. We want BESTEC to raise its white flag. Look at it, 4558, bring it all the way down to 1558. And again, we could reduce that amount even further. The reason why, because we have availability of 1167 in the capital one, and we have availability of 750 on the Wells Fargo. The reason why we cannot reduce it even further is because I haven't covered that lesson with you guys yet. Okay? Which means after lesson 7, you should be at 60 to 70% proficiency on how to properly run Ambroise Method 1.0. And 60 to 70% proficiency, again, is better than all the other debt repayment method out there. The debt snowball group, the debt avalanche group, the velocity banking group. Okay? 60-70% proficiency in Ambroise Method 1.0 is better than our competitors. And again, as you could see, this guy will never be able to compete with my method, our method, America, Ambroise Method 1.0. Okay? And in case they didn't hear it from last lesson, I would love to see a day when I get my butt kicked by that snowball. I would love to see a day when I get my butt kicked by that avalanche. And finally, America, I would love to see a day when I get my butt kicked by velocity banking. It's never, ever going to happen. Especially in a case where we have more account. The more account that we have, it's even easier, make my job way more easier. Because remember, we have a holistic approach. Okay? And again, we take care of the biggest problem, which is the APR. Not cash flow. We proven earlier that cash flow, okay, improving your cash flow position is not the best approach. In this example, we reduce our cash flow position from 400 to 306.42. Okay? All right, America. I'll give you 5 seconds to take a look at this real quick. Okay, America. Again, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0, our basic version. There is an advanced version that I'm working on, Ambroise Method 2.0, where I introduced more complex scenarios, more complex case study. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest costs compared to debt snowball, debt avalanche, velocity banking. Thank you, Jesus. Until next time, America.